Hello and welcome back to GBS lecture series. And this is Mohammed Ashik Khan, the managing partner and the technical lecturing consultant at GBS institution. And now today I'm picking up the one another discussion area on IAS 12. This is a continuation of my previous video on taxable temporary difference I have discussed. Today I'm planning to discuss deductible temporary difference, and this discussion is picked up from IAS 12, International Accounting Standard 12, and that is most applicable to students who are appearing ACCA exams for F7 and SBR, also Sri Lankan Chartered exams, or even CIMA exams or any other exams which are having similar discipline. So whatever comes under the discussion of the income taxation. Accounting for income taxation, and it's actually a bit of a vast area. I'm doing these videos on a bits and pieces. Today I plan to talk about one important area where most students find it a little bit difficult to understand. There's something called deductible temporary difference, which are temporary difference. Now there are two types of tax difference between accounting information, so accounting inputs, and the tax input. There is two types of difference. There are two types of difference. Those two types of differences are known as this tax differences, known as permanent and temporary. Some differences are permanent difference which will not reverse between period to period or time to time. That is permanent for between permanent for long. I mean permanent. There is no other point to talk about. Now I can give you one small example here. Entertainment expense considered to be permanent. So there are other differences which are temporary difference, and these temporary differences are again two types: taxable temporary difference and deductible temporary difference. If you have a taxable temporary difference, that will lead to deferred tax liability. I have gone through a very detailed discussion on that. Who want the more detail on that, please log into my YouTube channel. Kindly like it, subscribe it, share to everyone who would benefit from this, and also please remember to press the bell button so that you will be notified whenever I am uploading any brand new content on all these financial management, financial accounting, and other topics. So anyway, let's continue. So now this one, which are temporary difference that will result in amounts that are deductible in determining taxable profits or loss. Now when we are about to determine the taxable profits or loss, now this temporary difference that will result in amounts that are deductible. We could be able to deduct this in arriving the taxable profit. So now of future periods, when the carrying amount of the asset or liability is settled, this will revert or reverse in the future periods. So that is deductible temporary difference. Now for example, an entity has recorded a provision according to financial accounting principles under IAS 37. We need to record provisions, but under the tax principles when calculating tax return, we will not do that. So does not attract a tax relief until the entity actually spends the cash. So this is one good example of deductible temporary difference. Now so because of that, what will happen is that there will be a tax saving in the future. This tax saving will result into deferred tax asset. We will pick one example here. Now you see, I have just made some estimated numbers here. Profit before tax is 1000. 1000 for the sake of convenience, I have taken equal numbers. 1000 and 1000. And we purchased one asset, and that asset cost is $1,000 also. And so, according to the accounting depreciation policy, the lifetime of the asset is 4 years. According to the tax policy, the cost of the asset is still same, no problem. The lifetime of the asset is 5 years. So now, what we do is that we calculate the difference between the carrying amount of the asset and the tax base in order to arrive or find out the differences that would result into a deductible temporary difference. Now you see, my carrying amount, accounting carrying amount is 750. How? That is like this. I will show you that. Yeah. How I got this? 1000 cost of the asset and the end of the first year depreciation 250. So I got 750. And the second year 1000 minus 500, I get 500. Third year, how I got 500 is the accumulated depreciation for 2 years. First year 250, second year 250, so that I am getting 500. Third year accumulated depreciation is 750, so therefore the carrying amount of the asset is 250 and the fourth year accumulated depreciation is 1000. So the carrying amount becomes 0. But on the other hand, tax base, the cost is 1000, tax depreciation is 200, so the tax base of the first year becomes 800. Second year cost is 1000, the accumulated tax depreciation is 400, so the tax base 600. Third year 1000 minus 600 is the accumulated tax depreciation, so the tax base becomes 400, and the fourth year 1000 is the cost of the asset and 800 becomes the accumulated tax depreciation, so 200 is the tax base. And the last year cost is 1000 minus accumulated tax depreciation is 1000, so the tax base becomes 0. So accordingly, now you can see here there's a difference between this number and this number, and that difference is this. And you can also note that we are getting a minus here because for the purpose of tax we are deducting less amount than the accounting. So now we are keeping some additional amount of the tax base as a value of asset to be deducted for the future purposes. So that's why this 50 we are showing in brackets are known as deductible temporary difference. And in the question the given tax rate is 30%. So accordingly the end of the year deferred tax balance will be 50 into 30%, 15, 100 into 30%, 30, 150 into 30%, 45, and 200 into 30% is 60, and the last year is 0. So using this, now we calculate our tax working. Profit before tax, you see here, my profit before tax is 1000, 1000, 1000, 1000, 1000. And how I worked out this 315? 315, how I worked out actually this way. Yes, here you see, so my profit before tax is 1000 every year, and the depreciation I need to add back as a matter of calculating the taxable profit. This is part of the taxman's work. Here we need to add back the depreciation, and then we need to subtract the capital elements. We know that here depreciation is 250 per year, and the capital elements per year is 200. So this is 1000 divided by 4, and this is 1000 divided by 5. Accordingly, so every year I am getting 1050, 1050, 1050, and the last year zero depreciation, but capital elements 200, so 800. So accordingly, I am reporting a tax of 30% of 1050, 315, 315, 315. This is relatively greater than our normal circumstances. So now we go back to the P&L calculation. So we have charged our 315. This 315 is recorded as a liability. If you record your tax liability account, every year you will record 315 coming from P&L, and this 315 is the liability that we are planning to submit to tax department to be paid. In addition, in order to smooth out the accounts, we will then have deferred tax account. See, this I am crediting to P&L, so I should debit to deferred tax account. So every year I will be debiting. So second year will become another 15. I will be debiting. Third year, so third year again I will have 30 and one more. So 1, 2, third year 45, another 15 in the third year, in the fourth year. So when you go to the sixth year, this becomes 60, and we will be crediting to the certain release this to our P&L. So this will go to P&L. So this is what the one numerical example to elaborate how the deductible temporary differences working. With that, I will wind up this session, and this I will continue with another standard on the next video. I'm planning to look into financial instruments applicable to F7 level. So await for my next video. Thank you so much, and keep tuned on to GBS YouTube channel.